With today's overview, we're going to be covering topics such as credit score validation, credit exceptions, and non-traditional credit. And we're also going to share with you some of the frequently asked questions that we've received on credit. And we're going to share those through some trivia questions today. All right. So, depending how your day is going today, you may feel a bit like this, but we sure hope that navigating the applicant's credit review doesn't leave you feeling like this. Because reviewing credit for a USDA applicant really should not be much different than any other type of credit review. But if you ever find yourself feeling like this, it's probably because you're missing an essential element, and that would be your underwriter. When it comes to the credit review and those obstacles that you run into with the credit review, your underwriter is going to be your greatest resource. Working together with your underwriter, you'll be better able to navigate USDA guidelines. Remember that lenders may impose additional criteria and overlays at their discretion. So if something just isn't making sense or isn't connecting with what's in the USDA handbook, contact your underwriter because it's likely that it's a lender overlay, and that's why it's critical to always communicate with them. Now, as USDA lenders, it's important to understand the regulations that govern our program and ensure compliance with them at all times. However, it's also essential to recognize that ultimately the decision-making authority does lie with each individual lender. So while lenders must adhere to the guidelines that USDA sets forth in its regulatory guidelines, lenders make independent judgments based on their expertise and understanding of the market. So again, that's where that communication plays a key role in the underwriting analysis. Attachment 10A in our handbook is a great resource to assist with the credit review. Attachment 10A, again, can be found in Chapter 10 of Handbook 13555. This is available on the Link Training and Resource Library. If you haven't yet favorited this, make sure you do. This really is your one-stop shop for everything related to guaranteed for your resources or training. After you talk to your underwriter, you've reviewed your resources. If you still have questions, please reach out to our scenario desk team for assistance, and they'll be happy to help you. Because we only have 1 hour today, it's going to be impossible to cover everything in Chapter 10. So again, please make sure you take time to review the handbook and other tools that we have shared with you through the Link Library. All right, so we're going to start today talking a little bit about credit score validation. Gus is going to determine the acceptable credit score to be used for the underwriting recommendation. If a Gus accept or accept with full documentation underwriting recommendation is received, then no credit score validation is required. Now, that doesn't mean that the lender doesn't have to review the applicant's credit. The lender must still do their due diligence to ensure the creditworthiness of the applicant. Automated underwriting isn't perfect, and things may be discovered through a human review that Gus doesn't pick up on. So again, Gus accept doesn't mean an automatic approval. It just means that the credit score validation doesn't apply to those loans. An accept, though, does mean that your applicant will not be subject to certain waivers and verifications. And we're going to talk more about that as we go through the presentation today. Now, loans receiving a refer or refer with caution in GUS and manually underwritten loans do require credit score validation. And we're going to go into more detail on the next slide. A credit report with no score must refer to non-traditional trade line requirements. Okay, so for those loans that are a GUS refer with caution, or manually underwritten, one applicant whose income and or assets is used to originate the loan must have a validated credit score. The applicant must have 2 trade lines on the credit report that have been or are open for 12 months based on the date the account was open and stated on the credit report. Now, again, remember, a validated score does not indicate the applicant has an acceptable credit history. A validated score just confirms that one applicant has an eligible minimum credit history. The underwriter must still analyze the credit history. This slide shows examples of trade lines that are eligible to validate the credit score when a payment history is reflected. These trade lines can be open, closed, or paid in full. All right, now, as I mentioned a couple slides ago, today's presentation is going to include some scenario questions that our policy team has received from lenders. We like to include these in our presentations as it's a great way to see how we apply the regulation and handbook interpretations to real life scenarios that you see every day. So the first scenario we have is an applicant has 2 credit scores with the third credit score frozen. Does the third score need to be unfrozen? And the answer to that one is yes. Applicants must ensure credit data frozen at any credit repository is made available. The next question that we have is on a GUS refer, the applicant only has 1 credit score. However, the applicant has enough trade lines on the credit report to meet the credit score validation requirement. Are non-traditional trade lines also required? And the answer is no. Only 1 credit score is required as long as the credit score has been validated. All right, our next question on validation is on a GUS refer loan, there are 2 applicants on the loan and the primary applicant has a credit score and meets the requirements for a validated credit score. The co-applicant does not meet the validation criteria. Can I proceed? And the answer is maybe. This is going to be one of those where underwriter discretion is going to play a key role, and through their review, they may require additional verification. All right, with this one, an applicant has 2 auto loans reporting for 8 months and 4 months each. Can we use the aggregate of that to meet the requirement of an account reporting for 12 months? And the answer is no. You can't use the aggregate of 2 accounts to report for 12 months. A trade line must have been opened for a full 12 months to be an eligible trade line validating a credit score. All right, and next we are going to move on to non-traditional credit. So applicants without a conventional credit history or validated score can demonstrate their ability to meet obligations through alternative means through non-traditional credit. We never should use non-traditional credit to justify denying a loan. Ultimately, it is the lender's duty to assess whether the loan aligns with our agency guidelines and represents an acceptable credit risk, regardless of the GUS recommendation. Now, when we look at non-traditional credit, for applicants with a 12-month VOR, 2 trade lines are necessary. And your 2 trade lines would be the VOR and then 1 additional trade line from the credit report with a 12-month history or an acceptable non-traditional trade line. So you can combine a non-traditional trade line with a trade line off of the credit report to get your 2 trade lines. Applicants that lack a rental history, they're going to have to provide 3 trade lines. And then again, that can be a mix of traditional trade lines from the credit report or a 12-month history of eligible non-traditional trade lines. You can document non-traditional credit through a couple of different ways, through a non-traditional mortgage credit report, self-reported trade lines on a non-traditional credit report, or documentation from third-party verification, such as canceled checks or money orders, bank statements that clearly show the debit payments for the services or products, whatever it is that you're using for that trade line. Now, an eligible non-traditional trade line must have a 12-month history and should not have been closed more than 6 months before the loan application. And not going to go through all of the different types of sources that would be acceptable for this, but it could include utility services like gas, electric, water. You can look at landline telephone service, cable TV. And a recent update that we have made to our handbook is that we now can consider monthly subscription services, gym memberships, anything of that nature as an eligible source for a non-traditional trade line. So I know we received a lot of questions before this went into effect about, can I use their monthly subscription service to whatever it was, and we couldn't accept that, but now our handbook has been updated. So those would be valid sources for non-traditional credit. All right, and so we already went through the types of documentation that can be used to document the non-traditional credit. And so now we're going to look at a couple of scenarios with non-traditional credit and how we would interpret the handbook and regulation and how those would be answered. So this first one is, can an overdraft protection attached to a checking account be used as a non-traditional trade line? And the answer to that one is no. Overdraft protection is not a credit obligation, so it cannot be used as an alternate trade line. Is repayment on a 401k loan considered an acceptable non-traditional credit trade line? And that one also is no. 401k loans are considered personal funds, thus not an acceptable source for a non-traditional trade line. All right, can my borrower use verifications from 2 different addresses to combine 12 months rental history for non-traditional credit? And the answer to this one is actually yes. As long as the combined 12-month rental history does not have any gaps, it can be used for non-traditional credit. Now, I want to note, though, that this guidance specifically applies to rental history only. So a couple slides ago, we had said that you could not combine 2 sources to get that 12 months for a non-traditional trade line. So that does apply for non-traditional trade line. This is specifically for the rental history. So just keep that in mind. Again, you can't aggregate to get to that 12-month history for anything other than the rental history. All right, so next we're going to talk about addressing significant adverse credit that, unless it is remedied, it may render your applicant ineligible for a USDA loan. The first instance that we want to take a look at is delinquent federal taxes. Taxpayers who owe taxes and do not pay in full by the filing date are determined delinquent by the IRS. An IRS-approved extension to file a tax return does not grant them additional time to pay their taxes that are due. So they must pay their estimated income tax due by the IRS filing date, or they're considered delinquent. An applicant that's owed taxes on previous filed returns, again, they exhibit a pattern of taxes being due. So that's why we require that they pay that estimated tax payment to the IRS by the specified deadline. Now, if the applicant received refunds for the previous filed returned years, they can remain eligible with no payment due. Because if your documentation that you have is showing and supporting that they historically have not had to pay in, then we would not consider them delinquent. So you could proceed with that application. An applicant with delinquent federal tax debt is ineligible unless they have proof of a repayment plan that's been approved by the IRS and a minimum of 3 timely payments on each active repayment plan. And they cannot prepay a lump sum at one time to equal those 3 months. They actually have to wait for 3 months to elapse before they would be eligible. All right. The next situation we just want to touch briefly on is delinquent non-tax federal debt. Federal debts are typically discovered when you review the CAVERS result. And if the CAVERS indicates that the applicant is delinquent on a federal debt, then that applicant is going to be ineligible for USDA until they have resolved whatever issue it is that's causing that unacceptable CAVERS verification. Now, you can only run the CAVERS through GUS once, so you will have to run CAVERS outside of GUS once the issue's been remedied and that debt has been resolved. You'll have to run CAVERS outside of GUS to get verification that it now starts with the A code, and then you'll want to upload that to GUS and keep that with the permanent loan file. Delinquent child support. Applicants that are presently delinquent on court-ordered child support payments are ineligible unless the criteria listed on the slide here is met. The first step that you really need to look at is if that delinquent child support is subject to collection by an administrative offset. And then there's guidance based on whether it is subject to administrative offset or not subject to administrative offset. Administrative offset allows for the interception of certain federal payments in order to collect past due child support. And because delinquent child support is not considered a federal debt, it's not going to be reported to CAVERS. So they likely could have a clear CAVERS, but that is not going to be the documentation you need to make this acceptable. Again, because CAVERS really is not going to pick up on this, you need to have additional evidence to support that the applicant is eligible. Now, each state has an Office of Child Support Enforcement. When a state refers delinquent child support to the Department of Treasury, they typically are going to simultaneously report the delinquent child support to the credit bureau. So this is when you're typically going to discover the delinquent child support, usually when you're looking at the credit report. Verification from the Child Support Enforcement Agency may be necessary to verify if the delinquent support is, again, subject to that administrative offset. Lenders must document their loan file with verification an applicant with delinquent child support is not subject to that administrative offset. All right, so let's look at a couple more scenarios that we've received through our scenario desk. An applicant has a clear CAVERS result, but has had a wage garnishment for over 3 years on a U.S. education loan. Is the applicant eligible since the CAVERS was clear? And the answer is no. Even when the applicant's CAVERS is clear, if the credit indicates there is a delinquent federal debt, the applicant is ineligible unless the debt is paid in full or there's a release of liability. Our next scenario is the GUS underwriting report indicates that CAVERS has identified the applicant has a delinquent federal debt. However, we have documentation that this is no longer in the applicant's name. Is this documentation sufficient to proceed? And the answer is no. An A CAVERS response is the only acceptable result for an applicant to be eligible. So the applicant's going to have to contact the federal agency involved to clear it. A CAVERS response of A will need to be again, obtained outside of GUS and uploaded as part of the complete loan application. All right, an applicant with delinquent state taxes is ineligible for a USDA loan unless the debt is paid in full or they are released of liability. Would that be true or false? And that's false. Delinquent state taxes should be treated as an unpaid debt or collection, and the approved lender should evaluate whether that debt poses any threat to the first mortgage lien and if it's likely to have any type of adverse impact on the equity or the applicant's repayment ability. So this one, unlike the other significant adverse credits that an underwriter couldn't waive, when it comes to state taxes, this is going to be up to the underwriter and their discretion as to whether they're going to move forward with this loan or not, depending on their analysis of the loan and the impact that this may have on it. All right, so now we're going to take a look at the credit exceptions that the lender can approve. Now, these are specifically for GUS refer with caution, and manually underwritten loans. Credit exceptions are not required for GUS accept loans. So again, this is only those GUS refer with caution. All right, so in cases where there has been a foreclosure, bankruptcy, deed in sale less than 36 months ago, 30-day late rent or mortgage payments in the last 12 months, regardless of the GUS recommendation, it is the approved lender's responsibility to review and determine the loan meets the agency guidelines and it's an acceptable credit risk. The agency's minimum guidelines must be met. Again, the lender and the underwriter may have additional overlays or more stringent credit requirements. So again, those GUS accept loans, they don't necessarily require a credit exception, but the lender still has to evaluate the overall credit risk of that loan. Credit exceptions are not going to be required in the instances that are listed on this slide as examples here. That could include overdrafts, collections, disputed accounts, garnishments, non-federal judgments. Those would not require a credit exception. But again, the lender and the underwriter have to take that into consideration as part of their overall credit analysis. All right, so again, those few instances that we went over at the beginning of this section were instances of adverse credit that the lender cannot waive. So again, just another look at those non-tax federal debts, delinquent child support, ineligible CAVERS results, the lender cannot waive those. Another instance of significant adverse credit would be previous USDA losses that have occurred within 7 years of the submission date of the application. If you have an applicant who had a previous USDA rural development housing loan, so either a direct loan or a guaranteed loan, if there was a loss incurred with that loan previously, you can still consider them for another USDA loan. You'll want to process the loan as usual. You want to do your full underwrite of the loan. And if you feel that that previous loss, if there is justification to support the reason behind that loss, and you firmly feel that that has been resolved and that the agency is not likely to suffer a loss again, then you can submit a full underwrite of the loan in GUS, and USDA will take a look at it, and USDA will determine whether or not that applicant is eligible for another USDA loan. So this is really the only circumstance where USDA is going to be the one to make that final decision whether or not this credit is acceptable. It's when there's a previous USDA loss tied to it. And again, just make sure that you fully document your justification and reasoning behind why you feel that it no longer appears that there would be another loss incurred. Okay, so as you can see, guaranteed loans do allow for flexibility in credit analysis. So again, that's why it's always important to communicate with your underwriter. We all know that there's unique and non-recurring circumstances, and we recognize the ability of our lenders and their experienced staff to make these credit exceptions. So we're not going to make the credit decision except for that one instance if there happened to be a previous USDA loss. It's the only time when USDA is going to make that credit decision. Otherwise, it's the lender's responsibility to take a look at the loan and the overall risk of it. When making credit exceptions, you want to make sure that you document and demonstrate that the issues were temporary in nature, that they were beyond the applicant's control, and that they're unlikely to recur. One example of this would be if an applicant had a lesser paying job, but now has a job making considerable more. We would want to see that they now have health insurance to cover debts that previously contributed to the situation previously because they didn't have health insurance to help cover some medical debts that they had. And now they have health insurance and they're making considerable more money. Just kind of connect all those dots and document it for us so we can see why you feel that it's justified to make that credit exception. All right, so now we're going to take a look at a few scenarios that we have received questions on for credit exceptions. The first one's an applicant previously had a USDA foreclosure. Are they eligible for a new loan through USDA? And that is another maybe. Again, attachment 10A is going to outline the documentation that must be submitted as part of the fully underwritten loan to USDA. And just a special note on this, there is no pre-approval process for this. So we can't have you just send us part of an application and say, hey, can you take a look at this and see if you feel that you would approve this or not? We really need to have a complete loan application before making a determination like that. So you need to, again, do a full underwrite of that loan and submit it as a final submission in GUS. So we can see everything before we provide any type of response back. Will rule development guarantee a loan where the applicant has less than 3 years from bankruptcy? And again, that's another maybe. It's possible depending on the GUS findings and overall file documentation. If a GUS accept is obtained, then no further documentation is required, again, because you have that accept underwriting recommendation. If it's a refer, then the requirements of Chapter 10 would apply and a credit exception would be needed to be documented by the underwriter. All right. Does a refer recommendation in GUS automatically require a credit exception? And that is no. A credit exception is only going to be required if the refer is due to a credit issue or if the GUS findings require a credit exception. So again, refer with caution does not automatically equal the underwriter having to do a credit exception. You need to take a look at your findings report and then also just take a look at the applicant's credit and see if any of those issues considered significant derogatory credit are there, and then those would require the exception. All right, one of the compensating factors for ratio waiver on a refinance transaction states continuous employment with the current primary employer. what amount of time is required to use this compensating factor. And that's going to be at the underwriter discretion. So USDA, we do not publish a minimum history in order to apply to that compensating factor. Now, this is specifically for refinance loans, and it's going to be up to the underwriter again and their judgment as to what they feel an acceptable minimum job history is for that specific compensating factor. All right. So, although waivers, they're not required for all types of adverse credit, there are negative factors that could have an impact on the applicant's credit accounts and repayment of their proposed mortgage debts. Therefore, the lender should evaluate all their credit in their credit decision. So, next, we're going to highlight a few of those factors to always take into consideration in the overall risk analysis. The first we're going to look at is collection accounts. So, collection accounts, we don't require that all of them be paid. What we require is that you have to take a look at the total of the collections, and you also have to see if there's any medical collections in there, because we do not require that the medical collections be paid. And then when you're looking at those non-medical collection accounts, you need to see what the total of them is. And if they exceed 2,000, then you are going to either one, have to require payment in full of those accounts prior to closing, or two, you can use an existing repayment agreement or require a payment arrangement be made and then have documentation to support that payment. Otherwise, the last option that you can consider when you have those non-medical collections exceeding 2,000 is just include 5% of the outstanding balance as the monthly liability amount. If you include the 5%, then no further documentation is required. So again, we don't necessarily require all collections to be paid. You really need to take a look at what is medical versus non-medical, and then if they exceed that 2,000 threshold. You may find, though, that the lender may have an overlay of what's required to be paid and not be paid, but this is what's required by USDA. Recent debts. During your review, you may uncover additional debts or higher payments on existing obligations after USDA has issued a conditional commitment to you, but before the loan has closed. So how do those impact the loan? If the cumulative debt amount is $50 or less, you can retain your conditional commitment. You don't have to request that USDA release that loan back to you in GUS. You can retain all of the documentation to support the new or increased debt and payments in the permanent loan file, and then no further action is required. Now, if the cumulative amount of those debts exceeds $50, so it's $51 or more, then you're going to have to request that GUS loan to be released back to you by USDA, and then you're going to have to enter the new or the increased debt amount, and then you need to rerun your GUS findings, because that can have a negative impact on the underwriting recommendation. It possibly could take what was a GUS accept to a GUS refer. So you're going to have to take a look at what your new findings report says. And then once you have completed that, you'll resubmit it to USDA for review, and then USDA will issue a new conditional commitment. And you'll have to take a look at if there's any additional conditions that have been added prior to closing. And then just remember not to close, don't ever close a loan without a valid conditional commitment. So if it has to be reprocessed by USDA, you need to wait to close that loan until you have a new valid conditional commitment. All right. If the property is located in a community property state, then you would want to follow the guidelines for non-purchasing spouse debts. GUS can only retrieve credit reports for applicants. So, in cases where there is a non purchasing spouse, and this is a marital property state or community property state, then you're going to have to obtain a credit report for the non purchasing spouse outside of GUS and then manually enter those debts into GUS. Now, each state may be different on what debts are required to be included, what can be excluded. We are not experts in every state's laws when it comes to non-purchasing spouse debts. So that is going to be your responsibility. So I would say just include them all. If any of them have to be excluded, then you want, again, make sure that you document your file to specifically show the state law, state statute that allows for any of those non-purchasing spouse debts to be omitted. Rent history, of course, your rent history is going to be a huge indicator of the applicant's future mortgage payment probability. So if the applicant's payment of their rent is listed on the income expenses on the GUS application page, then you're going to have documentation to support that in your file. A verification of rent isn't automatically going to be required for every loan. You want to check your findings report to see whether or not a 12-month verification is required. And then remember, mentioned previously, if one rent or mortgage payment was paid 30 or more days late in the previous 12 months, that is considered significant derogatory credit, and a credit exception is going to be required for those GUS refer with caution, or manually underwritten loans. So again, just pay special attention to your GUS findings report to see whether or not that verification of rent is required. All right, so to conclude today's presentation, we just want to go through briefly all of the tools and resources that are available to assist you. The first one is that attachment 10A, because we were talking specifically about credit today. I just want to point out that one of the best resources to help you along the way in the credit review is attachment 10A. So you can find that in Chapter 10 of Handbook 13555. This is an amazing tool put together by our policy team. It's very easy to follow, understand. So any questions that you have credit related, make sure that you check out this attachment 10A. Then our link library, again, as I said at the very beginning today, this is really your number one destination for all of your origination and servicing resources. Make sure that you have this favorited, because you are going to probably refer to this webpage a lot with your USDA loans. We even now have consolidated our separate lender webpage with the link library. So now if you're looking for turn times, you can just go to the link library, and it's going to be the first thing that you see at the top is what our current turn times are. So we've tried to streamline where you can find your resources and not make you kind of hop from website to website. So now you should be able to find everything that you're looking for, again, in this one-stop shop of the link training and resource library. The next resource I just want to make sure that you are aware of is the Handbook 13555. Again, this is another great resource. It is broken out by chapter. Again, today we covered Chapter 10, which is all credit. It's very easy to navigate, very easy to find answers to the questions that you have. So make sure that you check out our online handbook with any questions that you have. One of the best resources is this FAQ resource. That is where I pulled the trivia questions that we use for today. It really is just a compilation of all of the insightful questions that have been posed by lenders, and they necessitate a deeper understanding of how the regulations in the handbook policies pertain to their specific situations. So, I mean, we can't always find every answer to every question specifically in the handbook. We have to take what's in the handbook and interpret how it applies to some unique situations. So that's where this FAQ document comes in. It's updated frequently by our policy team. Again, a great tool to definitely make sure that you go and check out sometimes. Help contacts. If you have questions after reviewing all of your resources and your tools, our teams are here to help you out. Again, this help guide is available right from the link library. So if you do have a specific policy question, reach out to our policy team. If after today you want your team to have a little bit more in-depth training, you can reach out to our lender and partner activities team, and we would love to set up a training, personalized training with you and your team. So reach out if that's something that you're looking for. If you have a file that you've already submitted to USDA and now you have a question on that specific loan file, then please reach out to our OPD team that services the state that that property is located in. Before we sign off for today, I just really want to express from us at USDA a heartfelt gratitude to each of you for taking time to join this webinar today. I know it's a very busy time of season for everybody, so we're glad that you were able to step away for an hour and join us today. And we just want to let you all know that we really appreciate your ongoing support and commitment to the USDA program. And most important, the rural home buyers that we help throughout the year. Without you, we wouldn't be able to make the impact that we do on those rural communities. So thank you all for all of your efforts, and thanks to you, we have countless individuals that are going to be celebrating their first holiday season in their new homes. So no matter where or how you celebrate the holiday season, we just want to wish you a joyful and safe one. And we look forward to seeing you all next year when we start our 2025 training calendar for next year. So again, if you take a look at that link library, you'll be able to see our training schedule for 2025. So with that, again, thank you, everybody. Happy holidays and have a great rest of your day.